the next problem will be, what are the Fed going to do when tapering begins to undermine financial assets? Bond yields start rising and equity prices start falling. What I've seen so far is that the investment community, and by that I really mean the hedge funds, the investment managers who have a choice, if you like. If they begin to understand that there is an inflation problem, they either go and buy some gold or something that relates to gold, or alternatively now, they can buy Bitcoin. If not Bitcoin itself, they can deal in regulated equivalents like futures and so on and so forth, which obviously has a knock-on effect in terms of demand for Bitcoin. Mm-hmm. So far, and I can understand this, every investment manager worth his salt is going to go where he thinks the performance is. So, when you see Bitcoin sort of move up from $40 to $70, that's where you go, isn't it? You don't mess around with gold, which has gone absolutely nowhere. So the result is that that the hotter side of investment money is all in cryptocurrencies. It is not at all in gold and silver. So that, if you like, is an imbalance. And I think it's an important imbalance to understand, because the idea that Bitcoin is a hedge against money printing can only go so far. Bitcoin enthusiasts will claim that it is the replacement money for currencies. Once currency fails, then it's going to be, people are going to select distributed ledger cryptocurrencies like Bitcoin or Ethereum or whatever to do their transactions with. That is pie in the sky. It really is. You can begin to think that way if you move in circles which are entirely millennial geeks, who are sort of so sold on what they're doing, and they don't actually understand the wider world. But the wider world actually requires money it can trust. And that is not something that they don't understand on their mobile phone or whatever. It's going to be gold or silver, and most likely both. Now, there will come a point where people begin to understand this, that actually you've got to shift your strategy from hedging against excessive production of paper currencies to moving your investment into the most likely next money. Then you're taking a very different decision. And I think it's at that point that you will find there's a huge backwash out of cryptocurrencies into gold and silver. It's really quite simple. I don't know when it'll occur, but I do firmly believe it will occur. And I'd also add, cryptocurrency has been a wonderful ride for anyone who's got in there and enjoyed it so far. And I have no doubt that, the Bitcoins of this world can go quite a lot higher. But the level of enthusiasm for something that has no intrinsic value is essentially a bubble. I understand there are now 6,800 or over 6,800 cryptocurrencies in existence. That was looking at, that was just Googling it. And, there's only 180 paper currencies, sort of fiat currencies in existence. So you can see that gives you a sort of rough idea of the amount of speculation that is in that cryptocurrency space. Mm-hmm. And there's no doubt that this is behind the current move by central banks to produce their own cryptocurrency, central bank digital currencies. But I don't know of any central bank. I haven't seen anything in the committee which is being run by the Bank of International Settlements that suggests that this is anything but another means of expanding money and credit into the economy. In other words, that's just going to be further dilution. The idea that they can head off cryptocurrencies of the past by this mechanism is just complete nonsense. So it's a fascinating situation. I mean, people are going to write histories about this, rather like they did about the South Sea bubble, the Mississippi bubble, the tulip mania, and all the rest of them.
So, obviously we've seen both gold and silver break out to the upside of many of their moving averages recently. So what does the commitment of traders report have to do with the rally, Alasdair? Are there increases due to momentum, or are they driven by the COT reports?
Well, I don't think that the position is being driven by the COT reports, but we keep an eye on it because really what we want to see is the amount of bullishness that might be already in the particular metal. And I was looking at the situation on gold earlier today because the report was delayed actually until yesterday. And when you look at the managed money category, which basically are the hedge funds, these are algorithmic traders and all the rest of it, they have actually increased their position very, very sharply, which is hardly surprising because open interest since the beginning of this month has increased by over 100,000 contracts. I mean, that's a very, very big jump. So you would say on that basis that the market has suddenly become really quite overbought. Now, I mean, if we were dealing with a stock in the stock market, we would say that, it's time it had a little bit of consolidation back. We need to get it back into firmer hands before the next move can occur. But in the case of gold and silver, that's very often the right thing to do, but it's now becoming very much an event-driven situation because I find that people are beginning to wake up to this inflation threat. And then there is the next problem. The next problem will be, what are the Fed going to do when tapering begins to undermine financial assets? Bond yields start rising and equity prices start falling. I mean, from the Fed's point of view, that's not an outcome they want to see. So they will probably stop tapering quite smartly or adjust it. I think that's a good phrase, isn't it? They'll adjust their tapering. And if the stock market falls quite heavily, which I think is a very strong possibility, then the only way they can stop it is to bring back quantitative easing. And instead of doing, 125 a month or whatever, if they, they'd probably have to jack it up to over 200 billion a month, to try and stabilize the market. Now, that then destroys the dollar. But then you've got foreigners holding dollars already. And about 14 trillion, I think, at the last count of that, was invested in equities. Equities start tanking. If the Fed doesn't do anything about it, the foreigners are going to sell anyway. So, I think they've got to the point where they're damned if they do and they're damned if they don't. And that, I think, is going to be the next real problem that we're all going to face. And I think there's a general sense of unease developing, which I think is beginning to be reflected in the gold price. And I don't see the rise in the gold price stopping here necessarily. I think it's too early to say that people are viewing it as not so much the gold price rising, but the purchasing power of the dollar falling. But it's not going to take an awful lot for people to begin to think that way.
Mm-hmm. So you recently wrote an article as well about the golden cross in the 10-year Treasury yield. Could this be contributing to gold's momentum as well?
I think for technical traders, probably yes. The reason for pointing that out is that a golden cross is a very reliable indicator of a change in underlying trend. And in this case, the trend is of the yield on this 10-year US Treasury bond. What that is telling us is that the yield is going to go quite a lot higher. But if you marry that with what we've seen in terms of monetary inflation, I mean, it really should be no surprise. So the people who would pay attention to a golden cross aren't necessarily following the underlying developments, which are far more serious than a technical development that might support a rise in the yield to around about 3%, which is roughly what it's telling us at the moment. Mm. It's a lot more serious than that. And we're going to see yields on US debt far higher than that, I think, particularly at the short end. There may be some leveling out as you go longer and longer, because what tends to happen is that there is always an appetite amongst the pension funds and the insurance companies for long-term, high-yielding, nominal yielding government debt. So there will be some support at the long end. But what I do see is I see that interest rates at the short end, they will rise against the desire of the Fed. The Fed will have no option but to follow it. It won't be led by the Fed at all.